Thank you, everyone. I first must say that I am absolutely delighted with this panel's discussion this evening. I am entirely impressed with the quality of the folks that we have here, and please everyone, thank everyone for being here and giving us this. And I see that we have an editorial perspective on what we're happening, a practical perspective on what we're happening, and an academic perspective. And the question posed as, has the culture on Wall Street changed, frames an argument that we end up diverting from in order to try and explain. I think you could make the argument that it has or it hasn't, depending on the participants that are involved at the moment. But Wall Street, by its nature, puts levers of other persons' wealth in individuals' hands to do things that are either right or wrong, and it ends up becoming fundamentally a human question, which is very difficult to deal with from a policy perspective. The academic results I find fascinating. I'm just making a comment here, but just that the question there is, insofar as they tell us how the culture of the past has helped us. The culture of the present, whether or not it's changed, is a separate question. And I think driving the bad actors who are at the peak of their performance recently out of the market is going to, by itself, define an improvement. Only insofar as it takes new bad actors an opportunity to figure out how to do it again. The fundamental issue then becomes, how do we as a group and everyone else do what we can? We cannot unilaterally change this because of the nature of freedoms in this country and hopefully every other. To do the best we can, to understand our own wealth is going to be derived through the grace of God. By doing the right thing over the long time, by taking less each time from each individual. The secular market calls it trust, customer satisfaction. They have all sorts of euphemisms for a good person. But the good person is usually the one in the bottom 10% who gets let go on any given year. So when we become senior managers, how do we look down on our organizations and try, with the wisdom of God, the wisdom of Solomon, to decide which among them should remain next year to advise our clients? Our clients themselves are subject to the same greed. That's part of the problem Wall Street suffers, is that they're having to deliver. They're being hired guns. So, I don't really have an answer or a real comment to say that this particular dynamic between is best represented here between these three speakers than I've seen it in any place ever before. So, just keep it up, because you certainly got my head spinning. You're on the right topic.
That you can recruit and you can cull good people and sort of, I guess, have metrics for figuring out who is a good person and who isn't. I don't know what those would be, but my experience on Wall Street is that it was completely a management culture, and the management is where I personally witnessed corruption. I worked in emerging markets where it was easier to hide, sort of structuring deals and balance restructuring that was questionable. But I saw unethical managers across the board, and those guys are still there. The best ones, a lot of them are still there. So how do you reform a person other than really providing strict parameters for them to follow, which the guys I knew were smarter than the parameters that were in place. So how do you really sort of change a person that is there with power, that is really the guy hiring? I mean, he can tell HR, this is the person that I'm going to hire, and if that guy wants to hire that person, I just cannot imagine that person's not going to get hired. And so those guys are still there. So how do you change that?
And I don't think will necessarily be replaced by the same type of personality. But the only way that you can control that kind of behavior is that obviously it has to come from the top, and you have to have incentives in place that says, that's not what we're looking for, that's not what I'm going to pay you for, and this is what I'm looking for. And unless you have that that clear-cut a directive, then it's very easy for people to continue to, to have bad behavior. And, you can argue that in the environment that we were in back in the 90s, and everybody was sort of just moving along, things were moving really fast, and there was a lot of money that was being made, then perhaps people weren't paying as much attention to the culture and the kinds of players that were in the house. But because of the kind of scrutiny that's on us as an industry now, and that's on us as individual firms, and the kind of accountability that we have to have broadly that I talked about earlier, that I think is forcing a look to who are the players that are in the house. Because as I said, there's too much liability today, broadly, if you're not really comfortable with who your players are. So I think over time, that some of the players that may still be bad apples that exist today will probably decide to retire or will get weeded out, because there's a lot of liability for firms if you have that kind of behavior.
Jeff said this was a debate. I don't remember it being a debate.
We're going to make it one.
I think they're nice.
Can we have another panelist, please?
I was hoping that I would be the outlier, but I seem to be the centrist or something. I think that both of my colleagues' positions are logical and defensible, and I had experiences that have colored me in a different sense, where I saw the last couple of years thinking that today's discussion was maybe about the crisis. And so I think the crisis is an opportunity to examine it without having to unfairly scrutinize all of us here that we're here together in brotherhood, sisterhood. But I would rather target people that aren't here to defend themselves. That's at the Lehman estate, I noticed that the way that the derivative settlement for large institutions, say like AIG, and other large institutions that aren't necessarily represented here on the panel but might be in the audience, were handled very differently by the folks that were operating the machine at the time, allocating bailout money and stuff like that. And there were interesting patterns I never had a chance to talk about publicly, though I've seen Borofsky, who has monitored some of the government activity, might be worth discussing, that there were very different ways that derivative settlements took place between Lehman Brothers and AIG, and Goldman Sachs and AIG, and Deutsche Bank and AIG, and SocGen and AIG. I was not really a derivatives trader, though I did trade quite a lot of them. But like most traders, I didn't actually know what they were. But they were still lucrative for us. We used them for hedging. But usually you need a triggering event when you have a pool of structured instruments, and the definitions of triggering events all vary, but one of the more obvious ones would be if you have a mortgage pool, you'd need either one or some kind of large proportion of them to default. But if they don't default, they haven't really triggered anything. And yet what we had when the New York Fed, which was run by Geithner at the time, insisted that AIG be obliged to pay out 100 cents on the dollars if those instruments had all defaulted. Interestingly enough, very similar credit derivatives with Lehman Brothers weren't paid out at par, and they weren't paid out for several years. And the arbitrariness of stuff like that were things that I've gotten to see, which I don't really have culpability in. There are plenty of other things I'd like to confess to, but maybe in a smaller setting. And but there's a lot of stuff that hasn't really been examined that I'm always shocked that people in leadership in Wall Street haven't been more upset about. It's obvious things that were not right. I was at Bear Stearns. They were no worse of an actor than any others, although I don't have really a dog in the fight. My opportunity at Lehman Brothers and the liquidation of the estate was a great, actually, career move for me because it was lucrative and easy, boring. And we did some interesting stuff. It was a very large bankruptcy. But the system was confused by both leadership in Wall Street, but especially leadership in Treasury and other departments, saying that this is a crisis, we must do these crazy things. You must. Everything will end if you don't. And then they've been done, and no one's really been upset about them or the consequences of them, even though many arbitrary choices happen. I'm sorry, I'm not going to condemn my colleagues up here. It's awkward.
was the context of my statement, Mr. Mueller, about chaos breeds opportunity. And so let me give you all the context that I normally say that and how I'm normally quoted in the press when I say chaos breeds opportunity. I normally say that in the context that when things are awry and there is, in fact, a chaotic environment, that's your opportunity to put your imprimatur on the world and change things. And one of the things that I've been saying to a lot of my mentees and a lot of the people that I sponsor, and frankly, new people who are coming into the industry, because I do a lot of recruiting, is I said the good news about what happened in 2008, 2009, 2010 is that the rules are being rewritten. So here's an opportunity for you to contribute. There is no one right way of doing things. Firms aren't doing things the same way. They're trying to find a way to compete in this new environment. They're trying to find a way to attract and retain customers. So if you have something to offer that fits in that lane, you're going to have a great time on the street, and you're going to be very attractive to firms who are trying to do things and do it in a new way. Because there is that chaos. People are looking for new contributions. So that's the context when I say chaos breeds opportunity. But let me also add a footnote. I think the other good thing about the chaos is that to the extent that you might have wanted to have a different environment and you wanted to have different people, but for whatever reasons, from a competitive standpoint, you didn't think you could sanction that trader or you could sanction that manager that was printing money because they were making so much money. Because we have this kind of opportunity now, because we have this chaos, this is an opportunity for you to shift and change your culture if, as a leader, you weren't necessarily pleased with it, but that was just, quote, the way things were going. So I do think that we have all shifted because of what transpired, and that's why I'm so bullish on how I think the industry will behave and the kinds of people that I think will be attracted to this industry and that will stay in the industry. Now, I'm not saying that we won't have more bad apples here and there, because as Ethan so aptly put, we are humans and people are fallible and people will make poor judgments at specific times. But I think broadly, I would not expect 5 years from now, if we had this conversation, that we would be able to articulate all the incidences that we've seen in the last 5 years. And my last comment on a rebuttal is that I do not think that we are a machine for creating bad apples, Mr. Mueller. Now, again, I say that there are some bad apples that exist out there, but I certainly don't think that we are a machine. I am not naive. I'm 26 years old in this business. I didn't say my age. I'm 26 years old in this business. And I will tell you that I can look each of you in the eye and tell you that I have seen a lot more good people than I have seen bad people in my 26 years. And it's not just at my firm, it's across the street. So I do think, unfortunately, we got painted with a pretty broad brush. But, as the old saying goes, every dog has its day. And we had our day in 2008, 2009, 2010, and being painted as a bad industry. But I think the good news out of that is that we all are talking about who we are now. There is a conversation that did not exist prior to this crisis between Wall Street and Main Street. And the reason I'm bullish on going forward is that I think we are all more educated and we are better for what transpired. Before, people didn't ask the questions. They didn't, that's what we had, some of the issues that we had. They just sort of blindly went forward. But I think there's a level of individual due diligence that will happen no matter who you are, if you are at all touching this industry, either from an institutional or an individual perspective, which I think will serve us all well.
Well, I think that the conversation has gone in two different directions. One is about the ethical standards that ought to apply or have not applied. And my opening remarks were focused on a technical reason why, as I put it, Wall Street and Washington, D.C. are machines that manufacture bad apples. Justin, could we have the first, the one with the image of next, that's it. Rather than simply product placement for my book,
Carla will have a chance to put up the cover of her latest book.
it's an advertisement for my son, actually, who designed the cover. But the image on the cover is The Arrival of the Good Samaritan at the Inn by Gustave Doré. And I put that image on the cover, and it forms, I discuss in the central chapter of the book, because the parable of the Good Samaritan really encapsulate all of the transactions we can possibly have with our fellow man. The robbers who beat a man and left him for dead illustrate crime. The priest and the Levite who passed him by illustrate indifference. The transaction between the innkeeper and the Good Samaritan was a just exchange of money for services. And finally, the transaction between the Good Samaritan and the beaten man was a gift. He provided time and money rather than leaving him to die. But the parable was set up when a young man asked Jesus what he had to do to be saved. And it's interesting that he already knew the answer, because in that gospel at least, it was the young man who said, Jesus asked him, well, what does the law say? How do you read it? And he said, well, we should love God with all our heart and our neighbor as ourselves. And Jesus says, that you have answered that exactly right. Do that and you will live. And so, but he wanted to justify himself, so he asked, well, who is my neighbor? And that's what set up the parable. Can we have the next slide? Thomas Aquinas thought rather systematically about exactly what it means to love our neighbor and how we can learn more specifically what to do towards God and neighbor. Thomas Aquinas explained that the 10 Commandments are merely an expansion of the 2 great commandments. The first 3 commandments on what's traditionally called the left tablet are the ones that pertain to love of God. The first 3 commandments, that you should have no strange gods before me, that the second is basically about all honor going to God, and the third is that we should rest in God, and that's what keeping the Sabbath holy is about. All the rest of the commandments are about loving our neighbor, and Aquinas said some of them are about doing good. For example, honoring your father and mother. It's really the only commandment that tells you to do something positive. But the other are about refraining from injuring your neighbor. The 5th commandment is about not harming your neighbor's person. So there's a commandment against killing. The 6th commandment is about not harming your neighbor's spouse. So there's a commandment against adultery. The 7th pertains to not harming our neighbor in his external goods. So that's the commandment against stealing. And then we're told to behave properly in word. So there's a commandment against lying, and also in thought, and that's what the last 2 commandments are about, against coveting our neighbor's goods or our neighbor's spouse. Now, regulation of financial markets is not rocket science. Nearly all infractions that have come up here tonight or in the press have to do with violations of the 7th or 8th commandments, the commandments against lying and stealing. For example, Goldman Sachs settled with regulators for $500 million, basically for abetting lying in order to steal. So just like the young man who set up Jesus' parable, most of us already know what we ought to be doing. But my point about the bad apples was that no amount of financial market regulation can prevent people behaving badly when there is a wall of money funneling through Wall Street from Washington. What happened especially between 2000 and 2008 was that just as the standards for lending were lowered for the agencies Fannie Mae and Freddie Mac, foreign monetary authorities began buying federal agency securities. They were roughly $100 billion in the year 2000, and they zoomed to about $1 trillion in 2008, and they have since fallen to about $200 billion. So all that money was funneled basically into the U.S. housing market, and then three-quarters of it was withdrawn. So my first remarks about Aquinas's exposition of how the Ten Commandments are derived from the two great commandments tell us what we already know, just what the young man who posed the question already knew. We know how to avoid behaving badly. But my other remarks were to point out that there was a reason why people have been behaving worse over time, and it's because of the peculiarities in our monetary system. And until that is corrected, this will not have been the last financial crisis.
So do you think that there should never have been any intervention at all and no monetary stimulus in the last 5 years?
Okay. This first chart just shows the level of public debt as a share of U.S. GDP going back to 1790, I guess it is. And the top line shows the total public debt as a share of GDP. But there are two other lines. The one intermediate line is the public debt if you take out the amount that's invested in Social Security and civil service retirement trust funds. And then the bottom line is if you take out the money that is the public debt that's purchased by central banks, including the Fed and foreign central banks. As you can see, public debt shot up as a share of GDP after the financial market crisis, but the bottom line didn't move. It moved hardly at all, and the reason is that nearly all of that debt was purchased by central banks. Can we go forward to, that's, okay, this is, compares what I call the world dollar base, which is the total dollars created by the Fed plus the dollars purchased or sold by foreign central banks, versus the CPI non-durables, which are basically food and energy commodities. But I also show the dotted line, which is what the Fed does. That's the U.S. monetary base. Now, as you can see, the domestic portion often goes in the opposite direction from prices. In fact, I think that what the Federal Reserve did in response to the crisis made it worse, actually, because in order to double almost overnight the currency and bank reserves in the United States, interest rates had to fall so low that it vastly increased the demand for holding those dollars. And it was, it actually had a deflationary effect because of the massive increase in demand caused by what the Fed had to do to lower interest rates. And so I don't think that either Mr. Geithner or Mr. Bernanke understands how the system works, and I think they made things worse by their response.
Uh-oh. John, I'm being a glutton for punishment here. So every day we ask, lead us not into temptation, but apparently the government and Wall Street is ignoring that. What do you think solves this? Is it just beyond individual behavior or regulation, and we're talking about something that goes well beyond Wall Street and well beyond the U.S.? Give us some tidbit of optimism from your perspective.
One of the young people said to him, lead us not into temptation. We can find it pretty well for ourselves. As I suggested, I think the problem will not be solved until we readopt the first principle of American political economy, which is you don't print money to finance the federal budget. That is the beginning of all our problems. It causes Washington to behave badly because open-ended financing of deficits means that no discipline is necessary. So both parties, Democrat and Republican, have found that they can succeed politically. Democrats basically by expanding spending for favored constituents, and Republicans basically by expanding tax loopholes for favored constituents. That will go on as long as the Federal Reserve and foreign central banks provide the lighter fluid that is doused all over the ground, and all it takes is one match to set the whole thing off.
Carla, these issues with regard to Washington and the role of the government, obviously these are things that you've seen and your firm has had to wrestle with. What's your take on what John has to say about the government's role in sort of making this factory so productive?
Yeah, well, I'd have to disagree with John, and obviously, I think agree with Ethan based on the fact that you asked the question, or you're somewhere in the middle in there. But I think, given what we went through and given how fast it happened, we did what we needed to do in order to try to create some structure or some basis, if you will, for recovery. From that. And, Ethan said it earlier, maybe all the decisions that were made were not necessarily the best decisions at the time, but I would submit to you that this was unlike anything we had seen before, and you can only pull from history to some extent, but sometimes you are trying to figure it out as it's coming. So, we can all look back. Hindsight is certainly 20/20. And we're all very smart, analytical people in this room, so we can pull it apart and say what should have been done. But I think that if the actions that were taken back then had not been taken, I'm not sure we would be where we are now. Again, arguing there may still be some room to go, but I think that the recovery that we've seen in jobs, no question, John, you pointed to it earlier, that there's still people who are in trouble. And so, again, I say there's still some room to go, but I don't think we would have seen the kind of recovery that we've seen. I don't think that you'd have the foundation and platform of renewal and restoration that I think we have now. So, again, I'm not sure I would have made a different set of decisions if I had been in the heat of the fire at that time when those decisions needed to be made.
I think
do you
they
feel
said
good
they-
about that?
I think they said they didn't want me to stay. No, I think that I could be in finance more actively. Actually, I'm a partner in a hedge fund. But I am bored, and so I found that the culture change has taken the wind out of what was fun, but what was fun may not have been what's good. That is good in a right and a virtual sense, and not in every way bad. But it's not as exciting and stimulating, and you don't have to spend your whole life in one place necessarily. There's nothing wrong with careers. But I think that, we all have a short time on this planet, and you should do things that give you the most fulfillment. So I actually miss finance because it was much easier than managing people that make $10 an hour and threaten to kill each other sometimes, stuff like that. We have one guy who's about my size, and last week he beat up someone who's about 6'2", and he's not allowed in the office anymore right now. I do have a question.
Workplace violence is going to be the next panel.
I have a question for Carla. It's not a big deal. A lot of financial institutions a few years ago had some changes, and their stocks went up and down. A lot of them, actually all of them, received a lot of capital from different parts of Treasury and et cetera. Some of them said they never needed it. some of them said not only that they never needed it, but their VAR, their value at risk, actually skyrocketed right at the trough of the securities markets when they had all of this extra capital that they allegedly never needed, that they had hedged everything with. And then when the markets rebounded, they made a tremendous amount of money. Actually, Morgan Stanley isn't one of them. But there were some that denied, all of their senior management denied on TV and elsewhere that they never needed it, that it was, they did it, they took money, it took billions of dollars because they didn't want to humiliate all of their colleagues, and it would have been embarrassing if they had said that they didn't need it because it would have really hurt the financial system. Do you think that there are any institutions that didn't need capital, like 5, 10, 15, 25 billion, that took it because they were forced to, because they had to?
Well, I published a book on that subject, actually.
Could you put the cover up, please?
No, every discussion of economics should start with a very simple question, which is, what is economics about? And Jesus, of all people, gave the answer when he said that since the days of Noah and Lot, and until the end of the world, that is for a very long time, people have been doing and presumably will be doing 4 kinds of things. And he gave these examples: planting and building, buying and selling, marrying and being given in marriage, and eating and drinking. In other words, we spend most of our time producing, that's the planting and building, exchanging, that's the buying and selling, giving, that's the marrying and being given in marriage, and consuming or using, that's the eating and drinking. And in fact, economics began when Thomas Aquinas combined these 4 elements, drawing on just 2 men, Aristotle and St. Augustine, into the first comprehensive description of economics. That was in the mid-13th century. And that scholastic economics was taught for 5 centuries until Adam Smith tried to drastically simplify economics. And he did so because he wanted to be what he considered the Isaac Newton of moral philosophy. And he thought Isaac Newton had boiled all of natural philosophy, all of science, down to a simple principle of gravity. So Smith was trying to boil everything down as much as he could. And in the process, he got rid of 2 of those elements. He got rid of the element of distribution, the theory of gifts and their opposite crimes, and he got rid of the theory of utility, which describes consumption. About 100 years after Adam Smith, so-called neoclassical economists restored Augustine's theory of utility. And so economics today has 3 elements, but it's missing the most important one, which is the element of distribution. We describe our love, or its opposite, hate, towards other people by the way we distribute our wealth between ourselves and others. For example, if there were only 2 people in the world, Carla and myself, and I loved Carla equally with myself, I would give her half of my wealth and keep the other half for myself. It's basically that simple. And in fact, that's pretty much what happened when I got married. But, well, since then we've had 3 kids, and so our wealth has had to be divided first 2, 3, and then 4 and 5 times. And it's literally the case that greater love hath no man than to lay down his life for his friends, because it's something that you can only do once. If you gave away all your wealth, if I tried to share my wealth equally with the other 7 billion people on the planet, I wouldn't leave myself and my family enough to live on. And so loving everyone equally is flatly impossible. And that's why St. Augustine told us, because you cannot do good to all, you should focus on those who are in some way more closely connected to you. And that's essentially what we do in our family life when we make gifts to our spouse or our children. So in answer to your question, what's missing is the element of distribution, the element that explains how we express our love or hate towards other people. And I think that the economists are actually in the process of rediscovering that missing element, precisely because it's leading today's neoclassical economists to so many wrong conclusions about things.